feel like I should feel like I should feel like I should feel like I should go. Go. Feel like I should go. Feel like I should feel like I should feel like I should feel like I should go. Feel like I should go. Feel like I should feel like I should feel like I should feel like I should.
GETCRAK. Wake up, motherfucker.
Back to the exchange, these wildfires in the Los Angeles area are forcing tens of thousands of people to be evacuating or under evacuation. One of those evacuees is CoreLogic's president of Insurance Solutions, Garrett Gray. Diana Olick is back with us to kick things off for this discussion and interview. And Garrett, of course, we feel terribly for everything that's happened. We appreciate you being able to join us to talk about it. Diana, kick things off for us.
Thanks, Kelly. Yeah, again, we are so sorry for your losses. We know you live in Pacific Palisades. Your kids are in school there. First, tell us what happened to you yesterday.
Yeah, yesterday was an experience like I've never experienced. I was about 30 minutes away from where my kids were at school in my office, up Sunset, and got a call from people at our house saying that the hill behind us was on fire. I had a text from the school saying, come get your kids. And I was just trying to get down Sunset as fast as possible so that, and safely as possible so I could get my kids. The gridlock was really incredible. Once I got close to my street, which is Bienvenida, which is kind of in the heart of Pacific Palisades, the cars were just stopped and people were honking with a lot of panic, trying to get people to move. There was no place for people to move. I actually had somebody trying to pick up my kids, and they did pick up my kids, but they were stuck in that gridlock on my street. And they had to park their car and abandon the car. And I had to ask them to send my kids running down the street. And I was running up the street into the smoke to go get them, and was lucky enough to get them and be able to make a U-turn on Sunset and start heading towards Beverly Hills to get away from the impacted area.
But you are all safe, thankfully, and evacuated from the area. You told me you don't know what's happened to your home yet. Ironically, as we said, you are CoreLogic's president of Insurance Solutions. You're steeped in this kind of climate data and risk, and there are a slew of climate risk firms putting these scores on both residential and commercial real estate, including CoreLogic. What do these scores mean to you personally, and what should they mean to every homeowner in America?
Yeah, I bought this house so my kids could go to school on the same street. And I did that knowing that the CoreLogic fire risk score for my house was in the 80s out of 100, which is not good. Or it's high. It's essentially saying there's a high amount of risk. But we did that knowingly. Insurance has obviously been difficult to place, but we were able to have it placed. And over the years, I've watched my CoreLogic risk score continue to climb. And so, obviously accurately now it's been impacted. And I think these scores are really important for carriers and homeowners and people who are purchasing property to consider as they're looking at properties. And it's going to be helpful, hopefully, for carriers to get the right kind of data so that they can figure out how to price risk, and hopefully we can attract more carriers to come to places like California, as opposed to carriers that are having to feel like they leave the state.
Garrett, it's Kelly here. I have so many different questions, and what you just said was fascinating, because I wonder, okay, now what happens? You're presumably going to rebuild the house. I understand what you're saying about the school being on the road. We live in a neighborhood like that for the same reason. So, What do you do now? What do you expect other people kind of around you to do? And what's the impact ultimately going to be? Because like you said, I don't know. Will you be able to get coverage now going forward? What's going to happen to the pricing and availability? I mean, it's actually surprising me that you said it was fairly predictable that something like this would happen, because to us watching from afar, it just looks insane that something like this could happen to these neighborhoods.
I think it's interesting as you've been watching the risk scores climb, because our area has not had a major fire since 91, so 30 years. And so, but the data was starting to show our scientists that the risks continue to get worse. And if you think about the rains that we've had over the last couple of years, the foliage has grown, so there's more fuel. It's become even more risky than it already was. I think what's the long-term prospects? We're going to have to figure this out as a society. And this is not just a California wildfire problem. If you think about people in Florida and on the coastal areas, even in Texas, we have hail risk scores that are off the charts. I mean, there is so many different perils that carriers and property owners are having to contend with today that it really requires a ton of data to figure out what are the best ways to price these risks so that we can get more insurance carriers to be able to write policies, so there's more competition and more ability for people to get coverage.
And Garrett, you said you do have coverage from insurers, and those around you, a lot of them do, but you also know a lot about the claims and reconstruction system going on. You talked about concerns over supply chain. When all of this is over and done and you have to rebuild this huge swath of Los Angeles, what is that going to look like?
Yeah, when last night I got a video from a neighbor at 12 o'clock with a house just 2 doors down from me that was on fire, engulfed in flames. And so last night, I wasn't sure, is my house going to be there or not? And today I've got some reports that my house is probably still there. I think it's really important for everyone that's watching to know that even when you see houses that look intact, we don't know what happened on the inside. We don't know about the smoke damage, and the whole area has been devastated. And so there's not going to be power to this area. It's going to be very difficult to live in. And the reconstruction efforts that is going to be required to get Pacific Palisades in particular back up and running is going to be massive, and it's going to require contractors, some of which are my friends and have been in this space with me for 20 years. They're going to be coming from all over the country to try to meet the demand, because there's just going to be so many structures that need to be remediated and fixed. You can't tell from the outside.
Yo, what's up? It is January 9th, 2025. Market is closed today for Jimmy Carter. So I just wanted to show up here to go over some things that I was discussing last time about fundamental research, okay? And I just started off with that fire thing because I thought it was a very interesting little video, because a lot of the insurance now, they analyze things through models, and AI will determine if you get a policy or not and adjust it accordingly. So AI will definitely get involved. And so the other thing is, we're a very data-driven society now. Data will be the gold of the future, right? Well, it's already the gold. It's pretty much the gold right now, but it's going to be more so as we move along. In any case, what we're going to look about data, we're looking at fundamentals. This is how people usually evaluate stocks, right? So in the last presentations, at the end of it, I gave something about the valuations, fundamentals using ratios and stuff. So let's go over them again. All right, let's go over them again a bit. Let's see if I can find my videos or tabs, because I got a gajillion tabs now. No, I don't see it here. Let me see. Blah, 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 blah. Price objective. This one. Okay. All right, let's go to this one. Now, let's go back here. So one way is called the Buffett indicator. All right. This is one way of determining the value. The other way was Shiller PE ratio, price over earnings. Okay, this one is pretty popular. This one, let's see, look at the FAQ. And then another one is called the Brock value. All right, Brock value. Okay, so let's look at the Shiller one first. Okay, so let me give you the website here. Shiller PE ratio. Okay, let me get the music going. Okay, it's some background music. I like the violins. All right. Why is the P over E on this site different than what is reported by S&P and other sites? Okay, let's see. The P over E is listed on many other sites are based on earnings for previous year only. The figures on multipl.com are the PE10 or Shiller PE. They are the price to average earnings from the past 10 years. Because this factors in earnings from the previous 10 years, it is less prone to wild swings in any one year. Okay? Okay, what is the PE10? How is it calculated? Look at the yearly earning of the S&P 500 for each of the past 10 years. Adjust these earnings for inflation using the CPI. Average these values. Divide by 10. Okay, sum them up. Divide by 10. Take the current price of the S&P 500 and divide it by that number. Okay, so the person who came up with this was Robert Shiller. All right, and you can look him up, Yale University. So this metric is very popular. Now let's go back to the website. Here you see the bubble at multiple places. This was like the Great Depression. Right, you had a little bubble into it, and then stock market crash, Great Depression. That's what I believe this is. And there's another spike, the Great .com bubble, and now we're here. All right. So last time we were at this number, as I was talking about last presentation, October 2021, we reached a new high of 38 right here. So from COVID, right? So COVID was probably this thing here. And great financial crisis down here when the PE ratio was 14. Just before COVID, it was 30. I think it was just about 30. Yeah, close to 32. All right. So now we're going to get back to that high pretty soon, pretty shortly. We're at 37.58 on the Shiller PE ratio. Now let's look at another one. Let's look at the Buffett value here. Buffett indicator. The Buffett indicator or Buffett index or Buffett ratio is the ratio of the total United States stock market over GDP. So the ratio right now is 208%. This ratio fluctuates over time since the value of the stock market can be very volatile, but GDP tends to grow much more predictably. The current ratio of 208% is approximately 66.62% or about 2.2 standard deviations above the historical trend line, suggesting that the stock market is strongly overvalued to GDP. Why does this matter? The Buffett indicator expresses the value of the stock market in terms of the size of the U.S. economy. If the stock market value is growing much faster than the actual economy, then it may be in a bubble. So yeah, we are up here, and according to this indicator, we are at the same point as we were in the .com bubble if we take into account standard deviation, right? The .com bubble went up plus 2 standard deviations above, and we are now back up here. All right, so we have 2 indicators saying we are overvalued. Let me give you the link for this one. All right here, you can go there and get that. And now we have the Brock value. This is the last one here. And according to this indicator, I don't think they have like a description of how they calculate this one, but they do incorporate the bonds. okay, how the bond market is doing. So that'll determine how things are overvalued, undervalued. Last time it was overvalued was, you see here, in 2018 on that little correction. And the last time it was undervalued was during the COVID crash. And then once we got out of it into the 2022 to 2023, we started becoming overvalued. That's when Jerome Powell started increasing the interest rate. So as you see there, bonds now look much more attractive than the stock market when you compare them in terms of yield. All right, so that increases the corporate bond yield as well. These are the latest numbers updated in December 6th, with the US GDP at an estimated $29.525 trillion and medium-term corporate bonds yielding 5.13%. The intrinsic value of the S&P 500 index, as measured by the Brock value, is 2,877. So the S&P 500 shouldn't be at 6,000 according to this. It should be at 2,877. All right. So we are 111.6% above that value. Okay. Now I'll give you the link there so you can look at all that. Now, so why are we overvalued? Why are we overvalued? Why does the stock market keep going up? This is the question you should be asking. And the answer is liquidity. So yesterday we had Fed minutes. And the Fed minutes had an interesting little comment on it. So this one from Reuters, January 8, 2025, Michael S. Derby. I'll put the link here. Fed minutes show Wall Street pushed back expected end of balance sheet drawdown. What is that? What is that? You have to remember, there are two things that the Fed has been doing since the great financial crisis in 2007 to 2008. And that is something called interest rates, right? They lowered interest rate to 0. That's step one. Step two was something that hasn't been done before until that moment. That was called quantitative easing. What is quantitative easing? Quantitative easing is the buying of bonds. So the Fed went out there and started buying up treasuries. Okay, so now we are now unwinding them. Last time we tried to do that in any significant manner was 2018, and that was when we had that correction on quarter four, okay, Q4 of 2018, when we had a little hiccup when the junk bonds started going crazy. There was a lack of liquidity. So, and there was another time that there was a problem too in 2019 before COVID. So there were two times when QT had to be stopped. All right. So in any case, Fed meeting minutes show big banks eye June as quantitative tightening end. Fed minutes show period of uncertainty rising for measuring liquidity. Fed minutes say reverse repo use may again be sticky. All right, let me just read the article because I don't think you know what reverse repo means. So, Wall Street's biggest banks have pushed back the expected endgame for the Federal Reserve's ongoing efforts to shrink the size of its balance sheet. According to meeting minutes for the Federal Reserve's most recent policy meeting, banks told the Fed ahead of the December policy meeting that they saw this process ending in June of this year, a little later than what they had told the Fed ahead of the November policy meeting. The minutes of the December Federal Open Market Committee meeting said, recounting a briefing by a New York Fed official responsible for implementing monetary policy. The Fed's most recent meeting, held on December 17th to 18th, saw officials trim their interest rate target range by a quarter percentage point between 4.25 and 4.5%, cut back expectations of future rate cuts, and raise their estimated path for inflation. At the meeting, the Fed did not announce anything new on its balance sheet drawdown, but it did make a technical change in the rate paid on its reverse repo facility to help induce money market funds and others to move cash off the Fed's books and into private markets. The minutes update on the outlook for the Fed's balance sheet comes as many are looking to 2025 as the year the central bank ends its effort to shrink its holdings via a process referred to as quantitative tightening, or QT. So QT is the opposite of QE. Okay, we've been doing QE since 2007, and that ended once the Fed started raising interest rates, and they said, "That's it, we're done." So I think they try to start back QT even while the interest rates were going down in 2021. So that was kind of a clue that something was up. That they're trying to wrap this up as easily as they could while COVID was going on. Okay, because they had so much trouble doing this while interest rates were being risen at the same time. After more than doubling the size of its holdings into 2022 on an aggressive spate of bond buying driven by the COVID-19 pandemic, the Fed has been working to shed holdings of Treasury and mortgage bonds to eliminate excessive liquidity. That's taken Fed holdings from a peak of $9 trillion to just under $7 trillion. In shedding bonds, the Fed seeks to reduce liquidity levels to a point where money markets can have normal amounts of volatility, and the central bank retains firm control over the federal funds target range rate, its primary tool to influence the economy's momentum. Ahead of the November Fed's meeting, big banks told the New York Fed that they saw the QT process ending in May, with Fed holdings at about $6.375 trillion. That would likely leave banking sector reserves at $3.125 trillion, above the current level of $2.9 trillion right now. The challenge for the Fed has been that it is very hard to know when it's taken out too much liquidity, and overshooting the mark can lead to significant market churn, which the Fed has sought to avoid in the current episode by slowing down the pace of the balance sheet drawdown. Okay, also occluding the outlook for the Fed are ongoing uncertainties around government financing needs during the spring as Donald Trump returns as president. There have also been some hiccups in the private repo market, which led to large volatility at the end of the third quarter, of a level that some banks finally used the Fed's standing repo facility, which provides fast cash to eligible firms in size. The minutes flagged a number of issues in the new year for the Fed's work on its balance sheet. It said a return of the government borrowing debt limit could make it hard for the Fed to assess liquidity conditions. Also, a back-and-forth debt limit could also keep money pouring into the reverse repo facility, as Treasury bill issuance would likely drop. Well, what does that mean? Ooh, all that stuff is so important to how the stocks will behave this year. We have to get ready. Okay, guys, this is it. Your liquidity is going to be taken away at some point this year, causing a steep reaction. You already saw it last year with the yen carry trade. Now we're going to have something more. Okay. So let me see. I gave you guys the link, right? You guys got the link here. You can go and read that article again. Very important article, I believe. Now, we're going to read something else from JP Morgan. Here you go. Okay. When might the Fed end its quantitative tightening program? The most notable growth in liabilities under COVID-era quantitative easing were bank reserves, $2 trillion, and the reverse repo facility, $2 trillion. Former Federal Reserve Fed Chair Janet Yellen described the first episode of balance sheet drawdown from 2017 to 2019 to be like watching paint dry. This was largely the case until a spike in the overnight reverse repo rate in September 2019 by more than 3% above the Federal Reserve's target range at the time, forced the Fed to intervene and cut administered rates and end quantitative tightening. Since May, so that's in addition to what happened in 2018 when they had to stop raising interest rates, right? So towards the end of 2018, they decided, oh, we're going to stop interest rates in 2019, and that's how the stock market recovered that time. Now let's continue. Okay, let me zoom in some more. All right, here. Since May 2022, the Fed has reduced its balance sheet by almost $2 trillion. And it's similarly been like watching paint dry. However, the Fed and market participants are sensitive to avoid another liquidity scare. As such, investors are curious what might lead the Fed to end its current QT program and how soon. To answer this, it's useful to assess the liability side of the Fed's balance sheet to understand where the fresh digitally printed money ends up after buying a U.S. Treasury security. The most notable growth in liabilities under COVID-era quantitative easing were bank reserves and the reverse repo facility, RRP. Under the Fed's current QT program, declines in the RRP have accounted for most of the money drain from the system. The RRP is perceived as a measure of excess liquidity, meaning there are more dollars in short-term vehicles, primarily money market funds, than there are supply of treasury bills in the open market, and thus treasury collateral is provided at the Fed via the RRP. However, as the Fed's balance sheet continues to shrink, the RRP is well on its way to zero. Given this, a continuation of QT could last another 3 months without hiccup. Thereafter, most of the decline in liquidity is likely to be seen in falling bank reserves. All right. Very important there. Very important here. Right here. Right here. At the beginning of 2019, Fed Governor Waller noted that bank reserves of roughly 10 to 11% of GDP might be sufficient. Bank reserves as a percentage of GDP are currently at these levels, suggesting the Fed is poised to end QT sometime in the first half of 2025. We're here once RRP drainage is complete. Should the level of reserves fall below this threshold, however, it's likely to lead to volatility in short-term rates. Simply put, when there is enough short-term money liquidity in the system, short-term rates tend to be well behaved. When there isn't, overnight rates are at risk of spiking. Ooh, man. Okay, so you guys can read the rest of this thing. I think, let me see. Yeah, they got a nice chart here. Very nice. So you can look at that. I'm not a big central banker expert, so someone else will probably have to figure this one out for you guys. But all you got to say is that you don't want this thing to go down, okay? Because that's going to cause a shakeup in the stock market for sure. Once the bond market goes crazy, then the stock market goes with it. So that's what you got to watch out for this year. And here you go. You can go down here. The Fed, the New York Fed, gives you a nice little chart called the reverse repo chart, and it'll show you where we are. And if you look back in history, go back to COVID and all that stuff, see, nice. And we go back to 2018 too. You can see where we last had some reverse repo in here until 2018, and then once we got into late 2018, it started shrinking. You see, like all this stuff has disappeared, and then that's when they had trouble. That's when the Fed started having trouble, and that's when the stock market started going bonkers. That's where the problem started. And guess what? Look at where we're at right now. We have nice amounts of reverse repo to use to keep things calm. We're shrinking it. Now we're getting back down here. So in 2025, this will just go down to zero again, just like we were in 2018. And so what does that mean to 2019? And what does that mean to the financial plumbing? If there's no water flowing through that financial plumbing, guess what? They're going to take that water from your stocks. Stocks will have to go down. That's where the liquidity will have to come from. Okay? So, yes, look and pay attention to this stuff. It is important. This is what controls everything. Everything is controlled by one source, the Federal Reserve. So, yeah, I think I've given you enough for today for that. All right. I might go back to talk about fundamentals some other time, but I gave you a quick review here. I think this article is pretty good too. It shows you even more stuff about the Brock value and the Schiller PE. So I'll give you this one too, to give you this link. You can read this on your own. But that's why I say fundamentals don't matter. Okay? As long as the Fed keeps pumping, and there are many ways of it to print money, and QE has been a useful tool outside of reducing interest rates. All that stuff is going to disappear, right? We've gone through QT, we've reduced the balance sheet, and now this will disappear to zero, and then we're going to eat away at the bank's reserves. And so everything that's propping up the stock market to be where it is, because, hey, why are we up here? Why are stocks overvalued? Why do people keep saying it's overvalued, but the stock market keeps going up? Well, that's why. That's why. That's the reason. And I also discussed sometime in these earlier streams about looking at something called the FINRA. Yeah, one of these days I have to go back and talk about it too. That's also very important. Let me see if I can find it real quick for you guys. FINRA, blah, 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 margin statistics. So here, you can look it up yourself. FINRA gives you this data, but it's delayed, okay? It's like 2 months delayed. It's always stale data. They don't give you the up-to-date data. What this means, the margin statistics, is that everyone that has a brokerage account, they can get leverage easily by using a margin account, meaning that I get charged an interest rate over time. So every month I'll have to pay something to the brokerage account to add money to my account that doesn't belong to me. So I can leverage everything up like crazy. So even with options, it's already leveraged, right, by me buying like shares through a contract. Now I can even do it even more with money that I don't have by getting a margin account. So when you see this number being high, so if you look here, November 23rd to November 24th, 1 year, we went from 660 in millions. So that's under 660 billion, I guess, right? Okay. All the way up here to now 890. So it's been growing. This thing's been steadily growing up. November's was like the peak here, the recent peak. I don't know what December will be. And you can look at over time. Now, what's going to happen is there's going to be a rate of change, meaning that once this thing takes a dip, that's when you know that people are starting to pull out their money, because now they're not taking that leverage anymore. So that's one of the first signs there's a market top. We're not there yet. But and this number changes very slowly usually. But once you start seeing that, you'll know when the top is. And I gotta show you one of those charts. I think I have it somewhere. FINRA margin debt. Let's see. I haven't updated this since like last year, I think. See if I can find it. Okay, let's see. When's the last time I updated this thing? Yeah, it looks like I updated this last year, meaning 2023. I didn't even update this yet because there's nothing really to update. But here, let me try to show it for you guys. Okay. Share screen. There you guys go. Falling margin debt growth from high levels trigger a sell. Okay, so let me zoom in. Zoom in. Okay, so I take that data from FINRA right here. I get my data, okay? And you can get your spreadsheets and get your Excel, get it going, and then you get this thing, the margin debt, okay? Now, the blue line is the margin debt. The orange line is the rate of change. Rate of change is just like I take the number and subtract it from the previous one. And this one's a 15 month. So I take my number, subtract it from the 15 month. Once there's a peak in that rate of change, that'll tell me when there's a peak in the stock market. This is one way of doing it. Okay. So the last time you got a sell signal was here, right here. Probably 2021, just before the big implosion in 2022. So you got that peak, you knew something was up, something was going to happen. So the way it works is if that rate of change rises above negative 21%, it's a buy. If it falls below 48%, it's a sell. Okay, and I did that little spreadsheet. You can see here. Right, the last time there was a sell was November 2021. Pretty good. That was pretty much just before the final peak in late December, right into then the New Year's of 2022. And then let's see, what was the buy signal? Buy signal wasn't that good, right? The actual buying time was probably October 2022, so this was pretty late. If you had other signals, you probably could have got in at April or whatever, and you would have said the market was safe. But still, that it's not that good at doing the bottoms. But it was pretty good at the top. Pretty good at figuring out the top. So that's something you got to use. And this is a function of liquidity. If the Fed's not there giving that interest rate help boost and all this QE boost and it's all going away, you got to take that into account. That's why stocks can be overvalued. It has nothing to do with the fundamentals. It just has everything to do with how much dollar is in the system. That's it, the money supply. All right. So now let's go play some videos here of people talking about the rates and all that. So let's go to Permabull Tom Lee.
Yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in Fundstrat Head of Research and Fundstrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times. So I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from NVIDIA comes out yesterday, makes comments saying that, you know, some of the supercomputers are still, and the full, I guess, realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias, thinking, look, we've neared a top, or that stocks are just awful now. I think we're getting close to the point where, you know, you should be betting really and leaning heavily against that. I mean, even look at AI sentiment, it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
Alrighty. That's it. That was quick. So, what they're alluding to is this whole thing about Jensen Huang's like comment yesterday or something about that. So let me go over that a bit. Let me see what's going on here. So let's see. So, quantum computing stocks slump after NVIDIA CEO sees use many years away. Shares of quantum computing focused companies slumped on Wednesday after NVIDIA's CEO Jensen Huang said that very useful quantum computers are over a decade away. Rigetti Computing (RGTI) fell 35%. Arcit Quantum, D-Wave, QBTS nearly 30% each. IonQ, AONQ fell 28%. Quantum Computing QUBT, which announced a 100 million equity offering on Tuesday, saw its stock tumble about 32%. I think this is more important here. So QUBT, Quantum Computing, yeah, they issued more shares. So, well, there you go. That's probably what started it off. This thing just added to the pain. So, and I think a lot of small cap stocks were pretty much getting eaten alive yesterday. You know, they knew like Thursday there was going to be nobody trading, and the bond market and the dollar was kind of spiking. So that's just a recipe for disaster anyway. They're just adding on top of that. So I think Martin Shkreli had a nice day yesterday. So he had some relief. I don't know if he's gotten into the green on his shorts of quantum computing, but there you go. So this is what Jensen Huang said. If you had said 15 years for very useful quantum computers, that would probably be on the early side. If you said 30 years, it's probably on the late side. And if you pick 20, I think the whole bunch of us would believe it. Okay, so just that comment, huh? That was enough. All right. So again, I think the key point though is that interest rates really do matter. right now for these type of high flying stocks. That's why I said last year towards December, when Jerome Powell kind of took away the momentum, that this year was going to be very difficult. So a lot of my picks would have to be decided on the premise that you would have a bubble, and we are not getting that bubble apparently. Okay, so let me play another video here about D-Wave. So the D-Wave, one of those quantum computing stocks, they respond. All right, let's see.
Deirdre Bosa is joined by D-Wave CEO Alan Baratz. Welcome to both of you. Deirdre?
Hey, Kelly, it was Google indeed. It's Willow Chip. And just before we get to Alan, a little more context. D-Wave's market cap, it stood at around $200 million for most of last year, shot up to nearly $3 billion after that Willow breakthrough, spurred a surge in the sector. It's now down nearly 40% on the session. Alan, thank you so much for joining us and making the time. Tell us what exactly Jensen Huang, the leading authority on the future of computing, is getting wrong here.
So, Deirdre, thanks for the opportunity to be here. I very much appreciate it. I think that Jensen Huang is a very smart individual, and he's built an amazing company. And he may be the authority on many aspects of computing, but certainly not all aspects of computing, and certainly not quantum computing. In this case, he's dead wrong. And the reason he's wrong is that we at D-Wave are commercial today. We have companies like MasterCard, or NTT Docomo, or Pattison Food Group, or Ford Otosan that are using our quantum computers today in production to benefit their business operations. Not 30 years from now, not 20 years from now, not 15 years from now, but right now, today. And moreover, we have been able to solve problems on our quantum computer in the area of materials simulation in minutes that it would take well over millions of years to solve on the fastest supercomputers, which, by the way, happen to be massively parallel GPU computers. So Jensen should think a little bit about that. We are solving those problems in minutes today, and it would take millions of years to solve them on massively parallel systems that he provides. And by the way,
Alan,
I'd be happy to meet with Jensen anytime, any place to help fill in these gaps for him.
Alan, I got the opportunity to get to know D-Wave a little better over the last month or so, and your approach is very different than what Jensen Huang is talking about. It's limited to optimization problems, and you don't play in the same field as Jensen and NVIDIA and Google and IBM. Is that correct?
No. So when you say we're limited to optimization, that's not an accurate statement. We are very good at solving optimization problems. And frankly, optimization represents most of the important hard problems that businesses need to solve. And so we're proud of the fact that our quantum computers excel in that area. But that's not the only area where we play. We play in material simulation, we play in quantum cryptography and cybersecurity. We play in a broad set of areas. But you are right. We have taken a different approach to quantum from everybody else in the industry, and that is what has allowed us to become commercial today.
What you just described, Alan, sounds like what generative AI promises to do, optimization, simulations, et cetera. If D-Wave is offering better optimization and tools, then why aren't you valued like an AI company? Why is your revenue, bookings, and profitability contracting in the latest quarter?
So first of all, with respect to bookings and revenue, all I will say is that our business is actually growing quite nicely, and I am very much looking forward to sharing our Q4 and fiscal 24.
Was there an exception then? I mean, Q3 revenue was down 27% in your latest quarterly report. What happened?
As I said, Deirdre, I am really looking forward to sharing our Q4 and fiscal 24 financial and operating results when we report earnings. So, just stay tuned. Now, that having been said, AI and quantum are not competitive to one another. Yes, there are some areas where you might be able to use both systems. I talked about material simulation, but we are so far ahead of what massively parallel GPUs can do in the material simulation area that, I don't even view that as competitive. When it comes to optimization, there are attempts to use GPUs to solve optimization problems. It's not necessarily their sweet spot, and that is also an area where I think D-Wave's quantum computers excel. And that's why we are working with companies today to support their business operations.
Okay, and Alan, just to be really clear, though, you're saying that D-Wave does play in the same space that Jensen is talking about. I know that there's different approaches to quantum computing, annealing versus the gate model. I don't want to get into that, but you're saying that Jensen Huang has it all wrong.
What I'm saying is that Jensen Huang does not understand what you just said, which is that there are different approaches to quantum. Annealing and gate are the two primary approaches. And while his comments may not be totally off base for gate model quantum computers, they are 100% off base for annealing quantum computers. And he
walked
needs to
it
be
back a little. From dead wrong to not totally correct. You walked it back a little bit.
Hold on. When it comes to D-Wave and annealing quantum computing, he is dead wrong. We are not 30 years out. We are not 20 years out. We are not 15 years out. We are today. We are supporting businesses today with quantum compute to solve their hard problems. So in that sense, he is dead wrong. There are approaches to quantum computing that it will take longer to mature.
Okay, Alan, I think there's a lot of nuance in here, but we really appreciate you taking the time to come on and respond to those comments. Thanks very much.
My pleasure. Thank you.
Alan at
Appreciate
D-Wave.
your time.
I had the popcorn out for that. That was very interesting. I appreciate you both. Deirdre Bosa, Alan.
Yeah. All right. So yeah, Trope said inefficiency of the market. You speak of Google Willow makes a sector shoot up. One CEO's remark makes it drop down. Now, you have to remember, quantum was already going up with one company, IONQ. IONQ was the one that was already going up in September. The other guys just started following that one, right? So that was it. Like part one was IONQ breaking out because they got a nice fat contract from the government that juiced up that stock. Then you had Trump getting elected. Then you had Google Willow making comments about quantum. Then that's why it just kept pumping and pumping and pumping. And all those ones were like little penny stocks. It's not hard to pump those up, right? And once you run out of buyers, it's easy to dump. That's the key. So was it a perfect storm? Maybe. But I would say it's just liquidity, And Jerome Powell kind of preluded to all of that pop in the bubble. If we go with Stanley's pop the balloon, he was already killing those small caps. So it was inevitable that anything could have made that thing drop. You just had to wait. And I guess we didn't have to wait for Jerome Powell to talk. You just need to wait for Jensen Huang to talk about it. But I think, timing is really interesting because the day before, after market close, QUBT issued more shares for its stock. So I think somebody knew something was going to happen. They were already ready to dump their stocks out and say hey, the stock price is very high. We're going to issue more shares. And then boom, the next day in the morning, you have Jensen Huang talking about that. But this is why I got to do this DeMark stuff. Because if you go IONQ was the one that started it all, right? September, right here. You got a buy signal with the 9 count here. And then it started moving up. Now, I think the rest of those quantum computing stocks didn't really do anything until we got the election. So they started following it too. But this one was the longest trending one from around, say, $6, $7 to $50. And if you did the projection here, the D-Wave projection, okay, this is using DeMark indicators, D-Wave projection, they said the maximum target would have been $58. We got very close to that. At 54.72 high in January 7th. And that gave the last 13 count. So you have a 13, 9, 13. So 9, 13, 9, 13 And that was right after that, we had the final high, and then boom, you got the crash. So I think this is why, you know, we got to start learning these trend like signals. And the mark indicators is very esoteric. And I think this is the only way we can know when the bubble ends, right? Otherwise, you're gonna be like Skrelly. Skrelly's just gonna be like short here, short here, short here, short here. And even though he got like a nice relief drop, I think he's still down like 50%, right? He's still down $500,000. So actually timing the top is quite difficult for a bubble. And this is where I'm paying the big bucks for the DeMark indicators, and I'm trying to figure this out for you guys and try to learn this. I think this is the only way you can really, really do trend following in a way where you can find out the actual top and bottom. It's really hard to do otherwise. Okay. Wonder if Martin has reversed any. Yeah, he probably reversed some of it, but not all of it. Yeah, it's too late now. He got in too early. He got in way too early. And that's why if you want to short and you want to long at the very top and the very bottom, you got to learn some exotic technical indicators. And DeMark is one of those ones that, very few people understand to use, and very few people are willing to pay to get access to the indicators. These are not free indicators. And even if you pay for it, you don't even understand what the heck's going on. So I'm learning. But as you can see from this chart, very good. And you have the final C5 signal here. This is a C5, and that's a down. So that was the final top after a 13, and you got a down wave after that. Perfect. Beautiful. Okay, so this is what we're trying to get towards to find out the actual tops and bottoms. So I'm going to be working on that this year, trying to understand that. In any case, let's go to the charts right now for a brief time. Let's go look at the charts. But Martin doesn't care. I mean, he has money to spend. That's the thing. When you have a lot of money, you can you can afford to be stupid, right? You can afford to be imprecise. But for most people, you got to find out where the tops and bottoms are, because you cannot waste time calling things incorrectly. If you call things incorrectly, it doesn't matter. So, of course, it's a short. Of course, I want to short that thing. But if I short it at the wrong time, it's still wrong. I'm not Michael Burry. Michael Burry started shorting the stock market really early, before like 2006, 2007. So he was wrong for years, for probably a couple years, at least months before the stock market crashed. Like most of us would have been wiped out. Like we can't just be like, oh yeah, let's just short it. Come on, we don't have the money to afford to short it early. You gotta get the right moment to short it. All right. So that's where we're trying to do with this show here. Try to show you. Now, look at natural gas. So I'm waiting for this to short, right? I'm going to short natural gas. It's perfect signal right today. So stock market closed, but the commodities futures are open. And we see here, getting to this box, and now we're going down. All right. If this thing breaks tomorrow, yeah, that's it. Short, using KOLD. KOLD ETF. You want to short it, like there. You can buy it at $40 or less. Maybe you can get it pre-market or whatever tomorrow. Get in, and you can short natural gas, because I think this is the final blow off. You can't get any more good news for the weather, okay? I don't think you're going to get another massive snowstorm that can push this up back to 4.4. I think this is it. It's going to have a hard time getting above $4 per million BTUs for natural gas. Long-term, natural gas is bullish, but right now, short this sucker right back down to $3. That's where we're going to go. And then over the spring, we can go long again and look at natural gas companies better than the natural gas commodity itself. All right. Bitcoin. All right. So I was telling you guys last time I was thinking of a potential long here. So yesterday we had a very crazy spike down with the NASDAQ. I don't know what happened in midday that caused that. But I said, huh, interesting. Now we've gone back to 92,000 and done that. So let's look at the way it's moving here. Okay. Right now we're on a long-term trend since the XTF implosion in October 2022, November 2022, thanks to Sam Bankman-Fried. So now we've been moving up on this trend. Very nice, very nice. We were overbought last year around January, February, March, right? We've gotten to that point where we got overbought. And then we went sideways until the last dip here in August 2024. Very nice. Now we're doing this again. We got overbought. So are we going to go sideways or we're going to go back down? That's the question. If we break down below 90, then the best time to buy it would be around April, late April. Okay, so after tax season. So after you do your taxes, probably the time where Bitcoin will make a new low, or it could just go sideways from here. If it goes sideways, that'll be pretty good for the altcoins. But if it breaks down, not good for the altcoins. A lot of these altcoins will probably follow Bitcoin if it goes aggressively lower towards 70K. Okay. So let's see why I drew these little boxes like it did here. So if we look at the daily chart here, this was the last significant bar on Thursday, December 5th. You see this? You have a small body here. So it opened and closed within this red rectangle that I drew. And I drew this red rectangle just based on kind of where most of these bars congregate. You know, you see most of it is trying to like stay within this area. And then you see like it has these two tails up and down. So it dropped below here to 92,000. It went up above here to 104,000. But it stayed, the body of it stayed here. And most of the like candles you see like stays within this area, right? And it'll briefly go above or below, but we're stuck in this range right now. Now the next time if it fails here and drops below, then yeah, we're toast. We're gonna see bye. I think somebody in chat was saying like, oh, it's gonna go to 60,000. Yeah, that's possible. That's probably like right here. If it drops really fast, if it can drop really fast, goes below 90 and just doesn't stop, yeah, you're gonna see 60, no problem. That'll probably be a good buy. All right, so watch out for that for Bitcoin. But for now, yeah, maybe go long for one more attempt at here and then short it again going down. So if you're trying to short, you know, use the MSTR stock as a proxy, so you can short it directly. You can use options on MSTR if they're, but like CKJ3 said they were very expensive, so that's why I told him like I just use the ETFs. So you can use MSTZ. So MSTZ is when you want to short, so it's 2x leverage. This one MSTZ will go up when MSTR is going down, and then if you want to go long, MSTX is when this thing will go up alongside with MSTR 2x leverage. Okay, so MSTX, those are the ones you want to use if you want to trade MSTR. So let's say MSTR does one final bounce. Maybe we get lucky on Friday and everything goes up. The market goes up, the QQQ, because MSTR is included in the NASDAQ 100. So it will go up with the QQQ. So if it goes up here, like up to 400, that'll be the next time to short, and then that'll be it. Then we can go down, and this time it won't even stop at 320 or whatever, 290. It's going down to 198. So that'll be a very good short if you do it at the right moments. So this is where timing is critical. You can't be like Martin Shkreli and short it down here and it goes up here and it's finally going back down your direction, because I think Martin Shkreli was shorting MSTR right around here at $200 in October, or here at 250. So very bad time, because that was the big blow off on the bubble right here. So bubbles are very hard to short if you don't time it correctly. Okay. All right. So that's why we have to use these DeMark indicators. I think this is where the DeMark stuff really helps out when you understand them. And so if you're a guy that wants to play up and down like a maniac, you better time it right. So let's look at Bitcoin here, and let's look at the DeMark indicators for Bitcoin, right? So Bitcoin DeMark indicators on the daily chart, very nice. You see that 13 here. So that was the last major move for Bitcoin. It's trying to it started going flattish, right? It's not moving up at the same pace it did after the elections. And then when you had this final 13, that was the top. That was the top. December 17th. That was it. So, yeah, this is why I got to learn this stuff, because if I use this appropriately, and I'm just using the basic stuff here, because there's a lot of more things like combo and propulsion and all these things, which I don't understand how to use. I have the book and all that, but even then, the book doesn't go over the more esoteric things. This is when things get really wild. And then once they figure stuff out, they won't tell you, because once they have an edge, they're not going to tell you about it, right? Everything you can Google online about technical analysis is probably trash, because like everyone's using it. Once everyone uses it, it doesn't work anymore. It's always going to be the secret stuff that people don't tell you about. That's where you have to start studying real hard and finding people to tell you about it, because they won't tell many people about it. And DeMark indicators is one of those things. It's one of those things. Okay, that will give you that extra edge, that extra juice. Okay, so done with that. So that's what I'm gonna do this year. Try to figure that stuff out. That's one of the things. The other thing is to start trying to tell you about how to use Joe Rabel's things, the Wyckoff stuff, because Gary's asking about the Wyckoff and that. So I'm gonna read some of those blogs and things, and I think that will give you more basic knowledge. That'll be good. But let's go to the Wyckoff market discussion. So this was a clip they gave today. So let's see what they think the market will do. So these are the Wyckoff guys. Okay, here you go.
Bruce, just having some kind of trading range going into the new year, having that February decline that could come a little bit earlier, it could come in January, creating that type of local capitulation into the area where we had the decline before, the test before, the resistance become the support, shaking off weak hands by getting out of the channel like we did here. If we have something like this on the takeoff, that would indicate that we're done and we could start going up.
And when we were in the classroom, we were always saying, describe the motives of the composite operator. Think back to that MAGS chart, that ETF chart, and all that volume. We must assume that volume's so high that the MAGS, that the CO has dumped supply out into the lesser institutions in the public, and that was never in a hurry. They just raised cash. They want to buy good stocks at good prices. So they're going to wait until there's generally real pessimism on the street before they're going to step up and start to build support in these stocks.
All right. So I think you understand that. So I'm going to show you the cycle chart here. All right. So this using the cycle analysis. Right here. So you see that? So I'm using cycle analyzer, and I'm going to use the 182 because that's where we got a nice peak here, and we have another cycle called 82 cycles. So this is a daily chart, so 82 days and a 182-day cycle, right? So I think this will try to move up into Jerome Powell's talk right here. Jerome Powell will talk in 20 days, 20 days from now. So the end of January. Now, if he talks bad, maybe that's when we start going back down, right? Or Or maybe he talks good and it still goes up, and we just have bad earnings. So maybe one of those tech earnings like Apple or Amazon or Microsoft or Nvidia will take this down further. Okay? So there's a lot of expectations now on those earnings. We'll only have 7 to 10 stocks lifting up the S&P 500. So anything could make it go down at that point. On Friday, we will have unemployment data. We will have payroll data. That's one thing the whole market is waiting for. That might juice it up for another week. Inflation data next week probably might juice it up. Maybe TSMC earnings on Thursday morning to Friday will push it up even further. And then Jerome Powell will talk on the final week. Okay. And then we'll see what happens. That's it on the final week of January. But yes, earnings seasons are around the corner. Don't know what's going to happen. But yeah, so if we look back at that video, you see, let's go back to it.
The ETF chart. And
Channel
see what they
the
draw right here?
into the area where we had the decline before inflation, into the area where
right there, right there. So we're going to move up a bit and then we're going to drop again. And this time, this drop is going to go a lot further. So prepare yourselves. So don't buy the dip right now. This ain't the real dip. This dip is just for trading, for traders to trade back and forth. So anybody that's an investor, this ain't the place to be. Okay, so your 401k, IRA, whatever, if you've been waiting to buy, this ain't the place to buy. There'll be a better buy point somewhere down the line. This ain't it. All right. All right, guys. Okay, let's see what the next video is. Bill Ackman. Oh, Fannie Mae, Freddie Mac. This stuff is going to be fun. Okay, because let me show you. These two stocks, Fannie Mae, Freddie Mac, have been doing very well since the elections. And I was pretty much wondering where exactly would be the best place to get in. But CMA, what is it? Freddie Mae. They're both the same. So FMCC is one of them. So this was after the elections. You see that pump? So it's basically a penny stock right now. It's terrible to hold. Like if you see it, like it's always been bouncing around up and down from pennies up to $5, pennies up to $5. But Ackman tweeted out that he loved this stock, and this was like on Monday, December 30th, and it just started going crazy again. And now we're up here. So is this finally the time when this stock will break out and go back up to $90 before the great financial crisis? I have no clue. But you know what? Let's see. Let's see if you believe him. Because, Ackman's kind of a scumbag. Well, he is a scumbag. Because I remember this dude was crying his old eyes out in CNBC during March, during the COVID. That was right at the bottom. So if he's telling you to buy some stock or something, maybe it's overpriced at this point. Maybe you can get a better price on Freddie Mac and Fannie Mae sometime later. But let's play the video. Let's play the video.
Is the #1 most read on the Bloomberg terminal right now. It's easy to see why. This is something that investors have talked about for many, many years. Easier said than done. When you have a 30-year mortgage that's flirting with 7% still, regardless of rate cuts, how difficult will it be to privatize Fannie and Freddie?
I think that's the question. And as you mentioned, it's a very challenging task. It's a very tall order that we're working with here. And especially because it's largely dependent on politics and what the environment is looking like. As I've been speaking to sources, many people are saying that it's typically a bit more of a conversation under a Republican administration. And specifically, we have President-elect Trump that's going to be coming in. And during Trump 1.0, he actually was interested in potentially bringing them out of this conservatorship. And so we are seeing a massive rally coming off of the fact that people assume that if he has more time to do so and he has 4 years ahead, that there is potential that we could see this happen.
What does the process look like? I mean, is it something that Trump could do? Does Congress have to act? it's more complicated, I think, maybe than it seems at first blush.
It's definitely very complicated, and I think that that's something that it is a pair with Congress. It's also Trump, but it's also about how do these companies look when they come out of it. I mean, of course, when we're thinking about what Bill Ackman is saying in his tweet, he's talking about the idea of an IPO. Now, these companies have been under conservatorship since 2008, so they've been under the government purview for quite a while here, and that's something that if it were to come out, people are wondering how they would actually do. I mean, of course, if you look at the stock, it's very, very low, but we've seen an extreme rally that people are comparing to potentially a meme stock rally.
We should point out that it would be a secondary offering, not an initial public offering.
Right.
Because the stock trades already.
This is very true. This is very true. But if that were to happen, and we did see this happen, that would be about 1,200% above what Bill Ackman's initial purchase price was. So that would be an extreme gain, of course, for him and for others that decide to hop in on that trade.
So you could say that Ackman is talking his book here, but I think he's been pretty upfront about that. Let's talk about timelines. As you said, this would be a thorny process. This wouldn't be the first time that markets got really excited about a story and then had to wait for a little bit. But what are sources saying? What are analysts saying about when this might actually happen?
Right. I mean, so Bill Ackman does talk about late 2026. Now, analysts, I have been hearing people a bit more bearish about the idea of this actually occurring, but it depends on which side of the aisle that you're sitting on in terms of how this could potentially pan out. But it could take a while, and I've been speaking to sources that are saying that it wouldn't necessarily be a step one out of the gate thing that President Trump is interested in doing. It would likely be later in his tenure.
Okay, so I'm gonna play this thing here. It's not on schedule, but I don't think I'm going to comment on this article. Pretty quickly here. So we got this whole thing about deregulation and getting Fannie Mae, Freddie Mac back in line, back to being a private entity, I guess. That's interesting. And we also have this news about Federal Reserve President Barr. So I'm going to read these articles for you. Okay, let's see. See, I get that out the way. All right. Okay. Now, let me take this off the stage and put this on the stage. So we got one side here. Politico says Trump just won his first battle with the Fed without lifting a finger. The abrupt departure of a top official ensures that questions about the president's ability to chip away at the Fed's prized independence will linger. So I think this is pretty biased. This is Sam Sutton, January 7th, 2025. President-elect Donald Trump didn't have to ask Federal Reserve Vice Chair Michael Barr to step down from his role as the central bank's top regulator. As rumors mounted that Trump might try to demote him, Barr decided to spare everyone the trouble. I strongly value the independence of the Fed, Barr told Politico on Monday, shortly after he announced his plan to resign as vice chair of supervision. He said he chose to quit as vice chair while maintaining his seat as a Fed governor because he was worried that the risk of the departure over the position would end up being a political distraction for the Federal Reserve and me, and that would end up detracting from our ability to serve our mission. Barr's decision may have kept the Fed out of politically toxic battle with a president who wants to exert more influence over interest rate policy. But his choice to depart leaves unresolved the thorny legal arguments about whether Trump can fire or demote top Fed officials. Okay, this is key. All right, now we're going to read an Axion article, January 7th, all right, by Neil Irwin. How top Fed banks cops resignation limits Trump's options. Monday's decision by the Federal Reserve's top bank regulator to step down from his job, but not from the Fed entirely, is simultaneously less and more than meets the eye. Michael Barr's self-demotion clears the way for President-elect Trump to appoint a vice chair for supervision. It is no radical departure from past precedent. Fed governors have in the past stepped aside on the principle that a new president should get to appoint their own chief financial regulator. The Fed's regulatory side plays greater deference to the wishes of the president and Congress, in contrast to monetary policy, in which political independence is fiercely guarded. Barr's move was intended to get ahead of Trump possibly demoting him, which would have created a disruptive legal battle. Indeed, Barr's decision to remain a Fed governor, which limits Trump's options in appointing a new vice chair for supervision, is in some ways more of a break with precedents. Randall Kroesner, a President George W. Bush appointed Fed governor who focused on bank supervision, stepped aside in January 2009, making way for Dan Tarullo, President Obama's appointee, to the comparable role. In January 2017, Tarullo resigned, allowing Trump to eventually appoint Randall Quarles to the equivalent job. Quarles hung around through the first 12 months of the Biden administration, then resigned from the Fed in December 2021, opening up the new slot now occupied by Barr. The common thread is that these top bank supervision officials view their role as more explicitly carrying out the regulatory agenda of the president who appointed them, and that a new president is entitled in reasonable time to their own choices. In monetary policy, there's a deep institutional tradition of Fed governors seeking to adjust interest rate policy in the best interest of the economy, regardless of who is in the Oval Office. With Barr remaining at the Fed as a governor, Trump will either have to wait until there is a vacant governor slot to choose a chief regulator, or elevate a current governor, likely Michelle Bowman, whom he first appointed in 2018. One difference now compared to the Kroesner and Tarullo cases is that neither held the title of vice chair of supervision, which was only created as part of the Dodd-Frank Act. Barr's term in that role wasn't scheduled to expire until July 2026. It is unfortunate in terms of Fed independence that Barr has stepped down before the end of his term as vice chair in July 2026, at a time when he was subject to external pressure, wrote Krishna Guha and Marco Kazraki of Evercore ISI in a note. But we thought it would be unfeasible for him to remain in that seat for a year and a half. The problem lies in the way the term of vice chair of supervision became badly misaligned with the election cycle, when the Fed accepts the administration sets the direction on regulation as opposed to rates. Okay, so why did I go through all that shit? Well, if you remember at the beginning of the show, I talked about fundamentals. Then I said why fundamentals don't matter because of the Fed. The Fed sets the monetary policy. Monetary policy affects liquidity. Liquidity affects the stock market. This is where all this stuff matters, okay? The executive branch doesn't have a direct impact on monetary policy, okay? There's one government that has a direct influence on both monetary and fiscal policy. That's China. Everyone else pretty much adheres to the idea that the central bank has independence. Okay, so let's look at this. Let's look at AI. AI gives me some answers here. All right, let me see. Blah blah blah. So I'm gonna get AI to help me with this, since they do this very well. This helps out in your search. Okay, so I'm going to do this one here. So let's see if this works. Okay, let's go. So I searched fiscal versus monetary policy in China independence. In China, fiscal policy, which is controlled by the government through taxes and spending, has significantly more independence than monetary policy, which is largely directed by the state and often used to complement fiscal policy actions, meaning the central bank, the People's Bank of China has less autonomy in setting monetary policy decisions. This is due to the government's strong influence over the central bank to prioritize broader economic goals over purely monetary stability. So most of the West is like us. Jerome Powell can do whatever he wants outside influence of Congress or the president. Now, the EU is even worse than that. The EU has one central bank over many countries. Each country in the EU has its own fiscal policy set by their own president or their own parliament. So the EU has to control one currency called the euro, and that euro is split between many member countries, right? This is why England kept their British pound even when they were in the EU. They wanted to make sure they can control their monetary policy independently of the ECB central bank. Okay? So this is very important. This is one of the tools a government stays a government, right? And what's been happening, I guess, is that central banks have this independence, autonomy that they try to have influence over the economy outside of the political process. Only China doesn't do that. And the EU is even crazier, where they have multiple political actors outside of a single monetary control. Okay? So that will affect everything we go on from 2025 into the future. Because right now, Germany and France has a government that's not in cohesion, I guess. Their parliaments cannot have a centralized decision-making force right now, because I think they're going to have to do snap elections in both France and Germany to try to get a new coalition government going in each of those countries. But right now, yes, that's why the dollar is so strong. It's not just because of Trump. It's because the Europe is getting weaker because of the EU. So all these things put together sets a tone for this year. China will try to stimulate its economy. Europe is fractured and trying to avoid a recession. We are going up and we're going to do more stimulus in a sense, but at the same time doing tariffs. But because the dollar is so strong, especially against Europe, if Trump is going to do what I think he's going to do, he's going to use that strong dollar as a tool against Europe for sure. So he can enact a lot of tariffs on Europe, but we won't feel that much inflation because the dollar is way, way stronger right now and probably will continue to be stronger compared to the euro. Okay, so and this will affect a lot of things. So everything can go on right now that could break so many pieces around the globe. I don't know what it will be. Something will happen. Okay. In any case, I think you got some idea for that. Let me see something else. Valuing growth stocks. Yeah, I was gonna talk a little bit about this, but maybe I'll save it for some time else. Sometime else. Yeah, valuing. Man. Let's see, valuing growth stocks. Because since I was talking about like the IONQ, the quantum computing, I was talking about fundamentals. Maybe I'll briefly mention this because it's kind of related. Let's see. So growth stocks, how you evaluate them. Okay. So, usually fundamentally people use price over earnings, but that's kind of basic, very basic. That's not going to value the growth stocks that well. Growth stocks are companies that investors believe will outperform the market over time. To value growth stocks, investors can use fundamental analysis ratios to compare a stock's intrinsic value to its market price. Some metrics that can help with this include price to earnings growth. Okay, so this is the price to earnings ratio to the expected earnings growth rate. There's price to sales. That's another one. There's implied PE, so the number of years it will take a company to earn its price share, assuming the growth estimates are true. So there's other ways of doing that, right? So what I'm saying is that like a lot of these growth stocks, Nvidia are like one of them, right? That's like really overvalued, and you'll be like, hey, how do you figure that out? So I did this like search. I don't think AI gave me any answers here. This one here, I said like valuing software growth stocks, growth versus profitability. So I'm gonna see if any of these articles will give me something, because I think there was like a EBITDA value. Let me see if I can find something that'll tell you about that, so then you can know what that is. Blah blah blah. Or free cash flow. Yeah, I had another one where I searched earnings versus free cash flow. I think this is one of those things that they like to use too, free cash flow. Like that's like Amazon and Google, definitely one of those where they just say like, oh, we can evaluate like that. Earnings are a company's profitability, while free cash flow is the cash a company has available to reinvest or return to shareholders. A company's earnings are calculated by subtracting the cost of ingredients and other expenses from the revenue generated by selling a product, right, or service. Free cash flow is a measure of a company's financial health that shows the cash a company has left after accounting for cash outflows and spending on operations and assets. Free cash flow is calculated by subtracting operating costs and taxes from sales revenue, then subtracting required investments in operating capital. Free cash flow is important because it can reveal problems with a company's financial fundamentals before they appear on its income statement. I think this is where a lot of these high growth software companies, they are assessed by the free cash flow, all right, and growth. So that's why you see like, oh, they just focus on sales. Like we go here, like what would they do? Price to sales ratio instead of price to earnings ratio. So I mean, all I'm going to say about that is like you can change whatever fundamentals you want. Like you can assess any stock in however way you want. It doesn't matter. Eventually that shows up on the price in the chart. So if people want to evaluate oil companies in a different way than they evaluate a hardware company, a software company, right? An AI company, a quantum computing company, so be it. So it doesn't matter. This is where the problem exists. Everyone will have a different way of trying to evaluate a company. But I think this is just a rationalization to liquidity. If I have a lot of money in my pocket and I'm looking for stocks that pump very well, I'm going to the ones that show a lot of growth. And I could rationalize it out. I could say like, oh, well, you got to use price to sales, price to free cash flow, blah, blah, blah. How come? How come when I look at an oil company like Chevron, which makes money, actual billions of dollars, compared to like something like Amazon, right, which only recently had a profit, how come Amazon stock keeps going up in a way that Chevron doesn't? Right? I can rationalize it. So this is the rationalization. You are buying the future with Amazon. You're not buying the future with Chevron. And then you have to come up with all these new ratios and figure out new ways of fundamentally analyzing, right, these things. Okay? So that's why you see here, like there's tons of articles here. Let's look at one of these. I don't know what this is. Valuing software as a service companies, how to value a new software business. See, now they make articles trying to figure out like how you should evaluate. Oh, EBITDA base valuation. I'm not going to go what EBITDA stands for, but you see, like they can go through all these tricks, try to figure out like, oh yeah, this is how you should determine where the stock price should be. I don't care. I'm not going to waste my time. I think this is just a rationalization. This is just a way for people to feel comfortable with where a stock is. Nvidia should be $1,000 a share, $100 a share, $200 a share. I don't care. It's just based on who is willing to buy at a certain price, who is going to sell at a certain price, and that will determine where the stock will go. So there's always going to be people that try to rationalize why a stock should be where it is. So this is interesting. So I'll probably save this one, this article. Yeah, this is pretty good here. But as you can see, yeah, you can go through all the mental gymnastics just to prove your point, just to like rationalize everything. Yeah. All right. Interesting. This was written in December 3rd, 2024. Okay. Yeah, maybe I'll look through this one day. Go back to you. Now, let's go back to cycles. All right. Let me show you this video. This is where we're going to go today. We're going to go through the cycles. This was presented in January 6th of this week. So let's go to it.
Bring in your comments. I will monitor those live and parallel as always.
Okay.
I think that's a good starting point to have a rave host two experts. So let's start with a short look at what is going on in Bitcoin. So therefore, we will jump to our studio perspective here. So what we see here is the daily chart of Bitcoin. Yeah, you see here since end of November now for 2 months. So let's set this into context of some cycles.
Oh, Antoine's here. Okay. Sorry guys. Looks like my thing got shut down for a while. Okay, should I pay for a stock class? I got my bachelor's in business when I learned about stock. Unfortunately, that was years ago. No, you shouldn't. You shouldn't have to. I think all the basic stuff you can learn for free. You're just gonna have to spend time to practice. You know, like so you're gonna have to start reading charts and stuff. So I think most people they'll just try to like paper trade or something. That's one way to get better at it, and then try to apply it with real money after you get used to some methodology. That's the way to do it. Yeah. So I mean, unless you're really serious, and the only way you're really serious is like if you're trying to get to that next level where like you really want to make big ass money. But yeah, I don't think that's necessary. All right, so let's hold on. I get my memory set up here. All right, let's see. Okay. Blah blah blah. Because StreamYard's kind of get goofing off here. Yeah, I'm gonna run out of memory soon, I think. So let me hold up. Hold up, guys. So I'm gonna try to play this. Let's see if it can keep going.
Okay. So this is just one snap. Even though this is an opportunity, jump to today's session. So let's start with a short look at what is going on in Bitcoin. So therefore, we will jump to our studio perspective here. So what we see here is the daily chart of Bitcoin. Yeah, you see we're here kind of hovering around 95, 100K since end of November now for 2 months. So let's set this into context of some cycles. You see the spectrum here at the bottom, as always. This is the basic cycle scanner. And what we always try to, or what we always need to identify is the most dominant cycle, just using the spectrum here at the bottom. In today's session, I will mainly focus on these 205 days cycle, even though this is not the most dominant cycle, as you see from our ranking mechanism, it is a dominant cycle. So, but from the dominant ranking score, it would just be ranked at number 5. So it's not the most prominent ranking. But if you have watched my episode on Bitcoin, where I did analyze the Bitcoin cycle since 2010 and prior to all parabolic moves, you know that there is a nominal cycle around 200 days, which was always prominent and important in the Bitcoin crypto assets. So with that knowledge, there's a clear reason why not picking the 130 or the 310-day cycle. I will come to that in a minute. But we also see the peak here, which is not the best Bartel score, but it's still a valid peak. And we know from our historical analysis, so that the persistence of that cycle can only be seen if you analyze different snapshot in the historical data set. So this is just one snapshot. This is today's snapshot. But in order to also decide if a cycle is important, it's a kind of persistence. And this is from the long-term analysis. We know that 205 cycle is even more persistent than the other smaller ones. So long story short, or join me on next week's market forecast again. The 205-day cycle is important here. This is also explained in the Bitcoin workshop we hosted here. So that's the nominal 200-day cycle, which is important in Bitcoin. Before we come to the current action in that cycle, let's have a joint review about the historical performance of that cycle. And allow me to make some general comments also on that. So if you're new to cycle analysis, you need to be aware that we use those cycles for timing. So these tops and bottoms here in the cycle analysis do not indicate price targets. Yeah, so that this is a cycle which is just overlaid to price has nothing to do that this would be a price target. This would indicate tops or reversals in trend from the underlying data source at this moment in time. So this is what we are looking here. So therefore, and I often, at least to simplify the visualization, I use a kind of zigzag. So at this bottom here, then to that top. Then also wait a second here. Then we have a sideways period here into this. Then from here, we have an upswing to here. Then we have a sideways. We have an upswing into here. Here we have a downward, and here we have an upward swing into that period. So, and now we need to analyze. You could argue, yeah, he was not a very important downswing, but that's from a long-term perspective, we are still in an long-term uptrend or in a parabolic up move here regarding that cycle from 20K to even over 100K. And the downward phases or the timing when that cycle was in the downward period, which I just highlight here on top. So these have been the phases when that cycle have been in a downward timing window from the downward phase. That have been the situations in time when Bitcoin stopped or reversed the previous uptrend at that point in time and then moved more sideways. Yeah, not really downward, but sideways. And when we arrive at the next possible downward reversal in trend, then it reversed strong uptrend. Yeah, so in this upward segment, it really has run up again to that point. But then in this downward phase timing window here from October to early 2024, again, we just saw more or less sideways consolidation into early 2024. And then when the next upward leg kicked in, we saw huge upward momentum and here also more downward. So if the major long-term trend is anyhow upward, then a pause on the daily downward cycle is exactly what you would expect. So a sideways consolidation. And this is what we see here on those chart. This is also due to the fact that I would expect, or we will expect 5 iterations from that point here. So this was the count of 3, where we had the bottoming area of Bitcoin expected, and then we always have the count of 1, 2, 3, 4, and here we have the 5th repetition later in the future to look out. So these upswings here, 1, 2, 3, 4, 5 are now the expected upswings from this 205 days cycle. And we are now, or we have passed the 4th iteration now and are in expected downward move maybe into February. And that's now important if we come to the current situation. So therefore, let's zoom into where we are. We know that this is the 4th iteration, and this is the updated 5th iteration of the 200-day cycle during an upward momentum. So in that situation, which started November last year, now into maybe early this year. So this could be an expected another sideways phase for crypto or Bitcoin before the next and final up leg might start into summer 2025. So if you're aware with the older analysis, this cycle slightly shifted into the future. So previously we had April, now it's July, so 2 to 3 months, but that's quite the dynamic nature of cycles which we observe here. And you also need to bring in the seasonality of Bitcoin. So seasonality of Bitcoin is still very bullish into May. So I would not expect a major downward correction here as we have positive seasonality. So the yearly cycle is always bullish until April, May for Bitcoin. And second, we are still in the phase of 200 to 400 days after the past Bitcoin halving cycle, which happened last year, April. So this is also a 4 years, not really 4 years, but a halving cycle pattern, which always shows us that around 400 or up to 400 days after the halving cycle, there is then this huge upwing swing to be expected. So long term, still in the upward situation, we have not the count of 5 completed from previous up runs. We have positive seasonality, and we are still in the positive halving cycle window of around up to 400 days after the past halving cycle. So said that, I would look out for Bitcoin as a quick and dirty analysis, now maybe to consolidate sideways a little bit for the next 2 months, then with another final upswing into this summer, which would make then the completion of the count of 5. And this is also the ending of the positive seasonality. And then we have passed the positive halving.
Mic on.
Okay, so you guys got the idea there. The link is in the description. You can watch that video. So the videos are free. Yeah, you have to pay money if you want the access to the software. Anyway, that's it about that. And I'll play some more about the whole I guess he goes through the S&P 500, but I kind of already went over it, so I don't think you need that. You can just look back at what I said. So we have a little dip, right? And then we're right now, and then we're going to go back up, perhaps. So let's see what happens in Friday, tomorrow, when we have the payrolls data. Maybe that'll juice everything back up, so things will be going well into Jerome Powell's meeting. Okay, guys? Okay, so now let me take that off and show something else. Let's see. What I was going to show you guys. Some point and figure, I believe I was going to show you. See if I got it. Let's see if I got it. Point and figure, blah, blah, blah. Okay. See if I can get that for you. We can go from there. Okay. So let's share this screen. Okay, so point and figure. What I got here? I got here a target of 138 to 185,000 for Bitcoin. So that might be where we're gonna end up on summer. That'll be the end of it, though. That'll be the final end of it. I don't know if we're gonna get to 185. That'll be pretty good, but at least we'll get to 138, so around 140. Okay. Now, how did I get through all this stuff? We are going over. We're going to go over to a blog, all right? And then this blog give you some basic ideas. Let's see if I can find it. Wyckoff to power charting. Okay, here it is. All right, let's see, and then go back here, and I'll share it with you guys. All right, let's go here. So I'm gonna do this, and you'll see how I got that 138 to 185 with this basic analysis here, because that's a bit more complex, I think. So let's go with the basics. Swing Trading with Point and Figure, written on December 29th by Bruce Fraser. There are a number of effective swing trading systems being used today. Let's explore one that is popular among Wyckofians. It uses two inputs, point and figure charts and volume. Let's review this system with a case study of Charles Schwab Corporation, ticker SCHW. As markets are fractal, accumulation and distribution structures form in daily, weekly, and monthly timeframes. Swing trading structures typically form on daily charts that can be identified with one box point and figure charts and daily vertical bar charts. Charles Schwab Corporation forms a swing trading accumulation structure between July and October. In July, climactic selling volume ends the decline, and an automatic rally sets the support and resistance of a range-bound condition to follow. Subsequent volume on rallies and reactions tells the tale of latent accumulation. This chart is rich with Wyckofian principles, and it has been marked up for your study and evaluation. Let's turn our attention to the point and figure chart to demonstrate how much useful information is present for swing trading. So later on, I'm gonna have to do something because Garion asked me about those 9 points for buying and selling using Wyckoff principles and all that. So for now, let's just say, you see this. You have selling climax, SC. You have the standard test. You have the creek, automatic reaction, AR. All this stuff, back up, last point of supply, and then you have a rally. So this is using the standard chart, right? Bar chart, candlestick chart, whatever. You can see this structure. Now, what we want to do is use point and figure. Point and figure, you can use stock charts to get the point and figure chart. That's why I showed you with that Bitcoin, right? With the point and figure, you kind of eliminate all this noise. See, this is all noise. What you do is you're focusing in on these areas where, look at that. It's a rectangle, right? It's a range. It's a cause. It's a structure where you go like, okay, is it going to go down from here or up from here, right? So let's go on. A one-box point and figure chart properly constructed will characterize the essential elements of the vertical chart. Vertical chart is this one. Okay, he calls it a horizontal chart, point and figure chart down here. Note how the point and figure strips out much of the noise and highlights the critical chart features. I often hear that traders find volume easier to read and interpret on point and figure chart. Therefore, it is suggested that all point and figure charts be plotted with volume. So the volume's down here. So now you just try to condense all this information here into this area here, right? So now everything looks a lot clearer. All right. A key feature of point figure charts is the estimation of the price objective determined by the size and structure of the accumulation. There is no other technique for estimating price objectives as effectively as horizontal point and figure counting. So that's what I did with Bitcoin. I find these structures and I use this to determine where the next swing up is going to be, if it's accumulation here. And then you can use this, you can find out where the distribution is, like here, right? Right there. There's no other technique, right, as that. Point figure is a centuries-old, tried and true approach to evaluating and trading financial instruments. For swing trading purposes, a one-box reversal point and figure is generated using traditional scaling. The up and down swings are clearly revealed with this method. With one box point and figure, the horizontal structure is well-defined and the volume patterns are illuminating. And you can read down here everything we're talking about. So when you do the Wyckoff stuff, so Garian, if you're listening, like go through this, like figure this out. So this is all you got to look for, right? And you know, you can go through that 9-point buy and sell talk in the blog. I think let me try to find it. So if you go to the Wyckoff website, I don't know if it's free materials or something like that. What was it? Wyckoff method or something like that. Wyckoff method, a tutorial. I don't know. I don't know if the tutorial has it. Let me see. Let me see if the tutorial has it. But the Wyckoff website definitely has it. Yeah, that's for sure. I talk about that 9-point and all that stuff. Let's see something here. Blah, 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 blah. Yeah, the Wyckoff method probably does have it here. Okay. Okay. Let's see. All right, go over here. Go to the Wyckoff method website. Let's see. Okay, so Garen was asking me about this. Yeah, this thing here. 9 buying and selling tests. Okay, so they give you like these 9 points. Let's see, 1, 2, 3, yeah, something like that. Yeah, preliminary support, activity bullish, downward stride broken, higher lows, higher highs, stock stronger than the market, base forming, estimated upside profit potential at least 3 times the loss of initial. So yeah, so you can use this, yeah, if you want. So you try to find and pass all these tests before you can consider like, oh yeah, this is a place to buy. Yeah, you can definitely do this. So once you have all that, that's why they give you these notes here. So you're trying to figure out like, okay, you got this along with the point and figure. You can figure out all these things were completed. So you got the selling climax, you got the volume expands with each rally. So the column X's as accumulation matures, right? So this is it. You got a lot of X's coming through from here to here, and the final one moving up. Pullback produces higher low. Price objectives generated by horizontal accumulation is estimated by the point and figure. So this is how they calculate it, right? You have 17 columns, $1 scale, 1 point reversal. So here you got 1 and 1. 1 times 1 is 1 times how many columns? 1, 2, 3, 4, 5, 6, 7, 8, 9. So this is 17 here, the yellowish area that was shaded. Then the buying climax is reached at 82. So this one, you count all this up, you add it to the bottom and the top, and then you have a new range here. So that's how you figure out that, okay, this is the top. So you swing trade that, and that's it. And then you can use this for a larger time frame, okay, instead of this one box reversal, right? So now that's why they give you this one, where you have a larger chart. This time you have a 3 reversal, box reversal here. You got 1 point scale, and then you can figure out what the larger trading range is. Because here, if you look back at 2019 for Charles Schwab, it can go up to 101 and 105. So that's the next target. So after you complete this one, it'll probably go down and then reaccumulate and then go up for the next stage to go up to 101 and 105. So this one you can look up yourself, okay? Look at this article yourself, and I think this is very valuable, okay? This one would be very valuable. Perfect. Yeah, so we can definitely discuss this further some other time, where we can go over other charts and look at their point and figures, just like I did here with Bitcoin. Right here, and this one I used an exponential one, where I used the percentage scaling. So that's why it behaves like this. Okay, that's why I get like the 1.05. I use 5% here, so that's where you get the 1.05. I have 24, so that because it's like 8 times 3. Okay, it's 24 columns, so 8 columns by 3 box, and then I'll do the same thing on the other one. All right. Anyway, that's what we're gonna go for. Now, let's see the other video I want to talk about. Okay, I'm gonna do natural gas, and then finally I'll end with a Joe Rabel one. All right. Okay, that's what I'm gonna do. Joe Rabel one. So this one I'm gonna do the natural gas one, so you can see how natural gas is playing out.
That's the 50-day in the S&P 500. Anyway, so let's talk a little bit about NVIDIA overall, outlining this new wave of super chips at the CES show on Monday. But supercomputers are still very power hungry, and our next guest thinks that natural gas could be the big beneficiary of that trend, and he's here to tell us how he's navigating that space, so to speak. So this is Rob Thummel, the senior portfolio manager over at Tortoise Capital. And Rob, natural gas, power generation, nuclear, solar, anything power related for data centers and AI is the big theme these days. But why nat gas versus, say, some of the other power sources?
Yeah, Don, so thanks for having me. So for the first time in my career, my 30-year career in energy, energy is intersecting with the technology sector. And so what that means for the future, in our opinion, is more talk about zettabytes and more talk about terawatt hours. But ultimately, it means more billions of cubic feet of natural gas. And that's what's going to be the future of energy going forward, because natural gas is going to be the main supply source of electricity generation, which is really, if you think about it, natural gas will be the lifeblood for a lot of these data centers. So if you look at a company like EQT, the largest producer of natural gas in the lowest cost basin, the Marcellus Shale, not too far away from where you guys are in Pennsylvania. That's a great way for investors to play the sector of higher natural gas production. And at Tortoise, we think natural gas production could increase by 30% between now and 2030.
So, Rob, just let's talk about this for a second, because we had Toby Rice of EQT on just a few days ago. And I asked him, basically what's going to happen with this huge tidal wave of supply that's coming online, all these new LNG import terminals being built and so forth. Won't that depress the price? Won't that be a problem for companies like his? And he admitted, he's like, look, we'd probably like to see prices in the 450 range to be more profitable than in the 350 range where they are now.
Yeah, and also Toby probably also talked to you about all the cost savings and cost cutting he's done to lower the production cost of natural gas. We have a real benefit in the United States in that we have a significant amount of low cost energy. It's really benefited us. It's derived from the U.S. shale revolution. It's still here. It's going to be here a long time. It's kept consumer prices low, inflation relatively low, and so we've got several more decades of this to produce.
Yeah.
And that will benefit higher industry in general.
Rob, let me just ask you, for those at home who are wondering, okay, so do I jump into EQT? Do I jump into LNG, the Cheniere I'm meaning? What are the names where you feel the highest confidence quickly where people can benefit?
Or pipelines even.
Sure, absolutely.
Yeah, well, and that's a good point, Dom. So I think if you think about energy and the circulatory system that you need, that's the distribution of energy out to the various sources. You need these pipelines, these energy pipelines, like Williams Companies. Williams Companies is an example. Owns a massive pipeline network, one of the largest pipeline networks really in the U.S. It's impossible to replicate. Huge economic moat. Got a 3 or 4% dividend yield. Going to grow the dividend 6% this year. Is going to benefit from all these growing trends, whether it's coal retirements and more natural gas, whether it's LNG and more exports of liquefied natural gas, or this AI development that's happening as well. You mentioned, Kelly, Cheniere LNG. U.S. is the largest exporter of LNG in the world. We're going to double LNG exports. Now, you were talking about a few days ago that's actually kind of gotten lost in this AI boom, but liquefied natural gas exports, it's going to be a big deal. And Cheniere is the largest exporter. Got a massive amount, high quality cash flows, lots of stock buybacks, lots of dividends coming from Cheniere as well.
All right, and those shares have been near all-time highs. Rob, thanks. We appreciate it.
Yeah, we'll definitely have to look at natural gas later on in the spring. Okay, guys? So that's definitely something that'll grow. And then last video, I'll just do Joe Rabel's video here. So maybe some guys will try to improve their timing. So you do the multi-time frame techniques.
This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabel. Welcome back. So what I'm going to do today is talk about multiple time frames. I want to show when I use an extra time frame during a pullback to really refine the entry, reduce the risk, make sure I'm not making a mistake just looking at 2 time frames. So let's go through this in detail. Now, if you want.
So yeah, you can go get his book over here if you want to take a screenshot. Yeah, Trope's already got it.
Obviously, I want to focus. I know there'll be some questions as to whether this is a good trade or not. And I don't really want to argue the merits when I look at the monthly and the weekly as to whether this is a good weekly, daily setup. All right. I want to focus more on the shorter time frames because that's really where this lesson comes in. So let's just talk about the bigger picture, though. Obviously, if we're looking at this as a pullback trade right here, we've got a rising 18 above a rising 40. We've had overrun here, and we have green DI showing a lot of strength, but we don't have ADX confirmation. And typically, if we're making a move, that's a continuation signal, right? It's not the start of a move, it's a continuation signal. We want to see that ADX confirming each new high. So again, the merits of this as a buy signal I'm not necessarily having a recommendation here, obviously, right? So I want to show how we can use these smaller time frames. Now, one of the things that I would say is that if you have this resistance up here, even if the momentum is good, all right, we've got to make sure we get really good entry because we know our target area is there's pretty good resistance up here. So we're going to need to be able to take a target or maybe 2 before we hit that resistance. So let's not worry too much about how good of a signal this is on the setup side. Let's look at the trigger side, because what I want you to show is we have this nice move to the upside. We get good confirmation that confirms this up move. And then we get our kind of an ABC pattern, right? Now the ABCs can come in different forms, and this one we're not making a lower low. What it did though is that it went inside the zone and then came out. All right. Now, everyone knows that when there's overrun, not everyone, but anyone who's taken my course knows that if there's overrun here, even if there's no sign of selling pressure, if you notice the ADX has stayed low throughout the pullback, then we need to give this a little bit more time, right? We need to make sure we get the second signal, not the first one. So this move up here that crossed above the 40 is not a signal for me because there was overrun. We want to wait for a pullback. And in most cases, what I'm looking for is a pullback that holds the 18. But there are times where we'll come in the zone and we'll come out of the zone. meaning come in the zone between the 18 and the 40, and then come out and we test this low. Now, what does that do? In this case, we don't have the downtrend line, but in a lot of cases, what that'll do is that'll be the 2 in a 1, 2, 3 change in trend. And when we get some sign of an up move, so if we get an up move here, it could be pretty attractive, and it would be kind of like the second signal, not the first crossover, but it would be the second one for MACD. That would be a lot more of interest to me. All right. Now, if you look at the way this pulled back, this portion of the chart, if we look at that in a zoomed out, hourly, we can see we made a move up, we rallied. We made a move down, we rallied up, came back down, tested the low, went to a new low, and have now rallied up. So we've clearly made our ABC, but look at the difference in the strength of the sellers here. All right. Now, if you're just looking at 2 time frames, you're saying I've got downside crossover here. I've got in the zone and out of the zone here. So any move back to the upside, right, would qualify because I've already made a move up and come back and tested. So if this starts to turn up and this starts to turn up, then I could take this trade. However, if I'm looking at this time frame, I recognize that that's really not a good idea, actually. We've got massive, massive overrun, almost to the point where it's oversold. But more important to me is this this sign of selling pressure based on the red DI. Red DI caused the ADX to go well above the 25 line. So when I see this, now I know I need green DI to actually make a move back up and form some kind of a pattern. So I'm not necessarily looking for a green bar entry now on the daily because I've gone and referenced the hourly chart. Now, what's important about this is that I don't have to trade off the hourly. All the hourly is doing is giving me a reference point and more detail into whether I should be taking the next setup here. So what it would tell me to do is if I'm taking this as a weekly daily, I probably want to be more patient. I probably don't want to take just a green bar to the upside. I really need a little bit more strength in the hourly DI, green DI, to kick in and show a little bit more strength from that standpoint, which means, maybe what I'm looking for is for it either to come back up through here or to come up, test the 18, and then turn up, which would be more in line with what we'd expect to see if the hourly does this. Now, again, you can keep an eye on the green if you want, but if you don't want to trade off the intraday chart or look at the intraday chart anymore, you can just use this as a reference and say, okay, I know this is a pretty strong pullback. I probably don't need to jump in right away. Now, for all I know, this is going to take off and just go. All right. And using the 2 time frames would have worked fine. All right. I mean, it does meet the criteria. And if you don't want to go down another time frame, that's a part of your plan and you don't look at that, that's fine too. But what I'm telling you is that I think if you do this, if you add this part of the equation in, it's going to help refine and reduce some stop outs. All right. You're going to see that a stock like this, maybe not every single time, right? Maybe this is going to be the one that goes, but say 8 times, 7 times out of 10, you're going to have more troubles here and potentially even have this fail. All right. So we want to keep this in mind when we're looking at these type of trades. If you're focusing in on the pullback here and coming in and out of the zone without looking at the strength of the pullback, it just lends itself to a lot more volatility, a lot more, like I say, a lot more times where you put your stop in and it comes down and it ends up taking you out before you see any real upside or anything like that. All right. So hopefully this will be useful to you. Make sure you keep an eye out on all these different time frames for entry. All right. Let me know if you have any questions.
Alrighty, okay, so there's a link for that video over there, and he has tons of other things on his channel, so you guys can practice it if you need that. But yeah, you can go very in depth with this stuff. In any case, let's see what we got here. For today. Market is not open, so all I can look at is Bitcoin right now. Bitcoin is now still on that downtrend. You see, like you got the 18 with the blue line, you got the 40 moving average with the orange line. I'm using a 40-minute chart right now, okay, to look at the crypto. If I look at the 4-hour chart, doesn't look very good, right? So this is before we have data from unemployment on Friday morning. This will decide everything, I think, right here. So this is really terrible, really terrible, really terrible. So I'm still waiting on something to change my mind to go long or whatever. But otherwise, it still looks like a short, still from that point of view. And if you look at the MSTR, yeah, that's what I use. So you can short MSTR. You can use the MSTZ ETF to short. But if it does reverse, comes back through 92 through 94, then yeah, MSTX is what you want. MSTX. Okay. Now in any case, let me see what we got here. Yeah, still got that downtrend. It has not broken. You got this one here. And you can look at this chart, right? You have the initial drop. And I was talking about last time, you could tell it was going to drop because of the way it was moving here. This was the last high. You peaked through 102,500. You peaked through here. This was the last like little green volume here, overnight volume. And then after that, you had the red candle. And then every time you had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 9. Okay, say so about 13, 14 candles here that was below this red candle there, and then eventually just broke through 101,000, very important area, broke through more, and then now we're here because last night, overnight, it didn't make any progress, still respecting to stay below that 18 40-minute chart, 40-minute candle chart, and it was just like, oh, yep, drop another one, another red candle through there, 95.6 thousand, 96.3 thousand, important zone, and then look at it, it just stays below there all early morning, like 2 days ago, and then finally we got that dip yesterday and Wednesday, and then still when it recovered, it tried to recover here, but then right after we just go do this, and then after that we just stay below that 18, continue on dropping. So yeah, there's no trend change right now. There is no trend change on Bitcoin, so we're going to have to rely on that data tomorrow morning, 5:30 my time Pacific, 8:30 Eastern, so 1 hour before market opens for the NYSE. So today we have market close, nothing going on, but we have this action here on Bitcoin. So that tells. Another thing I'm looking at, short natural gas right here. We're stuck here below this area. We're back below it, right? We tried to go through this back to $4 million BTU, British thermal units for natural gas. So use the KOLD ETF, KOLD. If you want to short natural gas, that's where I'm going to go in and then short this thing back down if this thing breaks tomorrow morning. So let's see what happens. So if we're going to go long, this thing has got to bounce right back up to 95. And maybe that's what we're going to do a long trade for there into Monday and then get out again. But if this thing just breaks down all the way through, then bye-bye. See ya. This thing will just fail completely. That means the NASDAQ will probably give up completely as well. So let's see where the NASDAQ's at on the futures point of view. Yeah, okay, we're here. So let's look at the daily. Yeah, this is about to curve down. So you look at the NASDAQ flattening 18 daily, and then you have now a flattening 40 daily. And then once this thing goes below zero, so the MACD, and you see the ADX here, we've got the red DI still above 25. So yeah, I don't see any improvement until we get how we go in the morning tomorrow. Okay, so right now no improvement. I'm expecting bearishness, but it can change very rapidly. All you need is a good employment data, and good meaning like the employment data is soft. I think right now we're in a point where we have to have bad data for us to continue to go up. Okay, that's how it is. So the Fed has said they worry more about inflation right now. So if you have a softening employment, then that'll be good. If you have a strong employment, that's probably bad. So the economy is too strong. They're going to care more about inflation. Interest rates will spike. Bitcoin will crash. NASDAQ will crash. Everything. Small caps will crash. Definitely small caps. Right now is terrible. As you can see, it's still on this bottom. This is the worst type of move ever since Jerome Powell here, December 18th. Terrible, completely terrible. Yeah, so this was most of the negative 4.4% in one day, and we still have been stuck there. Compare that to the Nasdaq. At least we're bouncing up and down. At least we're trying to save it, but everything could just be wiped out on Friday morning. Okay, so that's what I'm gonna watch on. If it's bullish, then we have a week of bullishness going into options expiration week next week. We probably will have I think CPI on Wednesday. I think that's true. Let me check. CPI on Wednesday, and then TSMC TSMC earnings on Thursday morning. Okay, so those will be the biggest things to watch out for next week. So let me check. Okay, PPI is Tuesday. Monday doesn't have anything. And then CPI on Wednesday. Yes, CPI will be on Wednesday. Yes. Okay, retail sales Thursday, building permits Friday. Okay, yeah. Wednesday and then Thursday. Let's see what happens. Okay, guys. Very good. Very good. So I'm watching to see if I want to go long here. If I'm going long, MSTX for Bitcoin, because that will give me the greatest juice. 2x on MSTX, and it also follows the Nasdaq. So if Nasdaq plus Bitcoin go up, MSTX will go really nicely back up. So I can get another 10-20%. Maybe if the strength is very strong, it can last till Monday. I'll get 30-40% on that move there on MSTX. If things break down, though, then I'm probably going to have to wait for another re-entry on MSTZ. I probably should have kept my MSTZ for that potential, but I just sold everything pretty much already yesterday, and then 2 days ago. It's just like, yeah, I sold most of the bulk of it. It's already gone. So my short on MSTR is done. It's already done. I'm not going to risk it for this, just in case we get a good number tomorrow. Okay, so that's the plan. I don't have anything else per se, but I did want to mention a few stocks. So I went over Fannie Mae, Freddie Mac, right? So let's do it again. Let me show you. Fannie Mae. Here we are. Let's do that. FNMA is Fannie Mae. Okay, so it's done very well since the tweet by Ackman just before New Year's. This thing was already moving up on Trump, but now we're moving back up. So this is a resistance here at $5. Once it breaks out, it breaks out. I'm not sure if it will, though. This could just be hype, so it's going to drop again, maybe. So FMCC, FNMA, penny stocks. These are penny stocks, all right? And then the other one was EXK. They had some bad news. This is silver miner here, Endeavor Silver Corporation. So it got down to $3.50. Perfect. $3.50. Bad news that their mines needs more construction because they had a delay in getting supplies to do construction on their mines. So they have a delay on one of their mines. The other one was PLG, Platinum Group. PLG is Platinum Group. Okay, so this one had a little dip at 1.53. I think this thing will curve around and go up. I don't know. Earnings is coming up soon, so I don't know if that was a wise choice for me to do that. I'm not sure if this is the correct date for earnings, but it looks like it's Friday, so I took a chance. I got it yesterday, so let's see if I'll add it more to it later. We have Mobileye, so I don't know what they said during the Consumer Electronics Conference, but it dropped, so I'm watching this one. This thing might go back to 14. Maybe that's where I'll buy it. So MBLY, Automated Vehicle Sensor Group, LiDAR, Mobileye Global, used to be owned by Intel, and they spun it back out. And then the last one I'll talk about is Geo Group Prisons. So I have no idea if there was news yesterday, but I saw that big pop. I was waiting for this to stick around here and wait for it to break out. It looks like it broke out yesterday. So private prisons, since the GOPs took control of the Senate and House, that's it. We have a good move up here from $15 to 25. Now it's at 31. So this could be the stock for next year. Yeah, so it's up 8% yesterday. Not sure why, but I like what I'm seeing. So GEO, Michael Burry of The Big Short, like I think he has this as one of his big stocks in his portfolio. Something I've been watching. Yeah, so let's see if this thing can continue to move up in this year. So let's see. So this, I can add this to my Axon and whatever. So this thing is actually, this area here, 25, has been a pretty good resistance level. So maybe this is a new base and a new breakout, and we're going to go up to new all-time highs once we get out here. So yes, GEO. Okay, guys, I'll see you around. Let's see what happens tomorrow morning. Remember, 5:30 my time Pacific, 8:30 Eastern. There will be unemployment payroll data, very important information before next week's Wednesday's CPI inflation data and TSMC's earnings, which will start off earning seasons for semiconductors and big tech Thursday morning. Okay, later.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go.